Hi guys, I'm Vedant, a first year student at BITS Pilani, Hyderabad. In this video, I'm going to share with you how to invest in a crash and how I personally dealt with it myself. A stock market crash are times of extreme volatility, fear and uncertainty. But it is also true that it is the best time to invest and learn to manage your feelings when it comes to investing. This is because you've already experienced the worst and after that the going just gets better. This extreme volatility can be explained by the fact that the present value of a stock or the market depends on what the public thinks about the future. Let me explain that with what is actually happening right now. India's GDP is expected to contract by 5%. The economy is supposed to shrink, but let's see what the stock market is doing. This is the graph of Nifty in the last 1 year. Well, we went through a massive crash, which is understandable because the pandemic shut all companies and businesses. But the market seems to be rising since the last 4 months. Well, why is this happening? Even though we know that the economy is going to shrink this year. Well, this is happening because we invest only if we think that it will grow in the future. Therefore, the public is seeing through the present situation. They are ignoring what is happening now because they believe the coming years will be better, and therefore they want to invest beforehand so they can see their money grow. Well, this is why the stock market is said to be a leading indicator of the economy. It is reflecting what is likely to happen in the future before it actually does. Pay attention on the word likely. Nobody knows what will happen in the future. We can also observe this in the crash. Well, the company's profits did not drop like this so immediately, but the public anticipated it and also correctly. Therefore, they sold even before the profits actually dropped. Well, this is the graph of Nifty for the last 20 years. Let me explain you why experiencing a crash is so important. Let's suppose you're somebody who started investing 5 years ago, somewhere around, say, July of 2015, say here. Well, clearly, everybody was essentially making very good money in the last 5 years, and therefore, people tend to get greedy and take more risk than they should. And that brings me to one of the greatest quotes by Warren Buffett. He says, be greedy when others are fearful, essentially in a crash. When others are fearful, they sell more than they should, and then you can buy them at a discount. And be fearful when others are getting too greedy. So, if others are getting too much greedy, you have to be fearful because you can expect a crash to come. Well, this is the graph of Nifty. Just the thing is, I took it in the last 6 months so we can concentrate in the crash period. Well, the first thing that we need to know is that no one can predict the bottom of the market. Therefore, trying to wait for the bottom is not the best approach. So, therefore, what you want to be doing is investing small chunks at regular intervals, say every 2 or 3 days. So, that way, you will be getting a lower average value, which will help you a lot. And that will make sure you don't miss out on the growth which is about to happen, which no one can predict when it will start. What we need to acknowledge is that it is clear to us now that 23rd March was the bottom, but looking at this trend you could have thought that it will drop even more. You really don't know. You could have even expected to make a new lower bottom after this 3rd April because it was falling here. Well, I hope that I proved that it is pointless to try and predict which one will be the bottom. I think we can now agree that investing small chunks consistently can help us get a lower value without worrying about trying to predict the bottom and missing out on the growth possibly. Therefore, let's assume you started investing on 17th March. Well, within 6 days between 17th March and 23rd March, you could have lost 15% of your money already. But therefore, that is why I said we need to be mentally prepared. This is bound to happen and will continue to happen. Therefore, you want to be buying consistently as the market falls and as the market rises. Therefore, you have a lower average value. And even investing the 17th March wouldn't seem so risky once we stayed patient, because if you see now, investing even on 17th March would have given us a good return if we just wait it out.
Believe me, everything I just explained is much easier said than done, and therefore, experiencing this volatility early on will make you mentally really strong for the rest of your investing career.
Nifty shows the overall movement of the market, which means that there were many stocks that actually plummeted and then bounced back, like Nifty is showing. I'm going to show you a stock that I actually bought and followed the strategy that I mentioned earlier of buying as it goes down and also as it comes up a little bit. However, I must warn you, I do not know whether the present price it is at is a good price to buy. I bought it when I considered it to be a good purchase. So do not follow anybody. Many people make the mistake of following whatever the big investor is doing. But the problem with that is, by the time the big investor actually announces what he did, he could have actually even sold the stock and booked his profit, and the stock could have been falling after that, and you would have bought it right then. I hope I made it very clear that what I'm going to show is for purely educational purposes only.
I'm going to show you everything really transparently because that's how I would have liked to see it, and it's all about building that trust between you and me. Well, some of you might say that you do not have 2500 rupees to invest. Well, the first thing I would like to say is that this included me saving up my pocket money in the lockdown, and also that I'm not spending this money. I'm actually learning a lot by experimenting. I happen to use Grow as my broker. Let me know in the comment section if you want to know my experience and review of it.
Don't forget to comment and let me know whether you want me to make a video on the Grow app which I use, so I can share all the pros and cons that I experienced.
As you can see, I made my first purchase at 800 rupees, then 865 and then 827, and that gave me an average price of 830. Well, it appears as if I should have bought everything on my first purchase at 800, but then to be honest, keeping the possibility that it may fall again open is much better, because on the day I bought, I really don't know whether it might fall to 750 the next day, 700 to the next day, and therefore keeping that possibility open and letting myself have the option of buying it again is much better. As you can see, I bought on 20th May, and on 22nd May it had gone to 865. Well, if I had bought everything again, I wouldn't have had the money to buy it on 27th May when it again fell. Therefore, it is always good to have some money on the side that is ready to be invested. It was very important for me to average out the price so I could get a good 26% return.
I also want to mention that when you buy stock, you're basically investing in a company, and therefore you have to learn to analyze a company. And to analyze a company, you'll have to go through the financial ratios, cash flow statements, balance sheets, and profit and loss statements. There are no shortcuts to this. Warren Buffett himself has said if you're not willing to do all this, then you shouldn't own a stock. Something else I wanted to add is even I am learning right now. Therefore, there was a good chance that I could have been wrong. We can only decrease this chance of being wrong by educating and experimenting initially with small amounts. I will make videos on how to analyze all these parameters that I just mentioned, but I am no expert, but I just knew enough to start, and therefore I'll learn some more and then make videos on them properly. The two key takeaways from this video should be: never follow anyone blindly, because even the best make mistakes and they might tell you what they did later. The second, never invest all your money at once and go all in. This is not gambling. Do not treat it that way. If you found this useful, make sure you smash that like button, subscribe if you haven't already, and hit the bell icon so you're notified the next time I upload the video, and share it with your friends.